Welcome to the final panel of the day here. Pleasure to see everyone here. Glad everyone is excited about the debt world as they are about the equity world. My name is Andy Weiss. I am a commercial mortgage broker with a firm called Dansker Capital Group. I broker loans in the $1 to $50 million space here in New York and nationally, and feel honored to be up here with a couple of great lenders to discuss how to survive your expiring bridge loan. I'm going to try to do my best to speak as little as possible and let you hear from the direct source itself. If each of you could just quickly go over your rundown background and maybe a little bit about your shop as well, just so everyone here knows.
Can I start with a question, Andy?
Sure.
Because you said there were a couple of great lenders, so a couple means two.
Sorry. There are a few great lenders. There are a few great lenders. Sorry, Ezra.
Just making sure. I'm assuming it was these two guys that were the couple great ones, and I was just the okay one.
Yeah.
So, everyone,
I don't know if this
thank you,
works.
Andy. My name is Ezra Dweck. I am the president and co-founder of IceCap Group. We are a New York-based bridge and term lender that kind of that spans the bridge from institutional to guy next door capital. We do 1 to 4 multifamily and mixed use, light rehab, heavy rehab, and bridge up to $10 million, and 3, 5, and 30-year term loans up to, let's say, $4.5 million. We have a nationwide footprint, so we lend in New York, New Jersey, and pretty much around the country. I heard someone mentioning out of state. We lend in out of state, but we are very still New York focused. New York, New Jersey, I think still accounts for 60% of our business. And by the way, as I look out, I see lots of friendly guys who we've done loans with and brokered to and accepted deals from. So hi everyone, good to see you, and that's me.
Hey everybody, my name is, how's that? My name is Alan Shayanfekr. I'm one of the co-founders and the CEO for Sharestates.com. Similar to Ezra, we are a private lender focused on bridge and term DSCR loans. We lend across the country in about 40 states, predominantly focused on residential, multifamily, and mixed-use assets. Loan sizes ranging anywhere from $100,000 up to $20 million. Our sweet spot's really though in the $1 to $7.5 million range. We'll do everything from light rehab and bridge loans up to ground-up construction. And for our term DSCR product, we offer 5, 7, and 10-year ARM hybrid loans with a 30-year term, fixed IO components for the first 5, 7, or 10 years. Been in business now for about 8.5 years, having done about 3.5, 3.6 billion in volume. Similar to Ezra, we are predominantly focused in the Northeast, New York and New Jersey being our 2 biggest states. And we're very big on relationship-based lending. So our goal is to work with brokers and borrowers and not only just do 1 or 2 loans, but to help them scale and grow their businesses and help them with their transitions from residential assets to multifamily assets, from rehabs to ground-up construction, so on and so forth.
Nope, maybe. There it is. My name is Sobel. I work at Walker Dunlop. It's a publicly traded company, but I work in the Fannie and Freddie space, really focus on anything $1 million plus. Walker has 8 different lending products, anything from construction to BFR, SFR, but really primarily what I focus on is in the Fannie and Freddie space. We also do HUD, and it's really multifamily, anywhere from the Northeast across the country. We travel with our clients anywhere you want to go, and we're more or less represented in every state that you could think of. Also, there's obviously not too many people in this room now, but I know when the equity group is, we have a pretty substantial sales team who's selling multifamily, industrial, retail, office everywhere in the country as well. And a lot of what we do is try and parlay the debt and the sales side to ultimately get deals done from all angles. Our clients own across the board, and we've done deals with people here, and we kind of take out a lot of the bridge stuff that guys like who are sitting up here do, because not everything we do is on the acquisition front, also refinances as well.
All right, great. Thank you for all sharing. So Jared, I'll start with you, and if we could start the panel really by going back to 2021, early 2022, just to preface, I guess, how we got to where we are. How are you underwriting leverage, rate to some extent, but really leverage on your bridge product? I know you're a big perm lender, obviously, and that's the end goal for you in most cases, but I'm sure you did a fair share of bridge lending over the past few years, and we'll hear from you guys in a moment on that. But I'm curious, as an agency lender, where were you pricing, let's say, on loan to cost and really sizing cash flow on a takeout from a debt deal perspective?
Yeah. I mean, pretty much every call that I would get in 2020, 2021 was basically what LTC will you go to? It's not basically where you start, it's where you stop. That was more or less where my conversation started, and I'm sure you can attest to that. And if my number didn't start with an 8 as 80 or 85, that we were really out of the market. And I would say that's probably why Walker was not like a leading bridge lender during the boom. You're competing with companies like Arbor, the Greystones of the world, the ReadyCaps of the world, who were going to 80, 85%. And they were doing this, and we were placing some of them for good clients, 250, 275. And I mean, probably, until the slowdown, I mean, even 325, 350 was a high spread. And they were doing this at more or less going in debt yields of 2, 3, 4% that were basically non-existent and made up. And they were stabilizing to, I did something with Ladder at like a 675, and I'd say that the high, I mean, if you were trying to stabilize to a 7.25, you were maybe out of the market when the bridge was really booming. And we were kind of talking about before, and I think, you're just funny thinking about that, because you tell a client, hey, you go in at a stabilized 7.25, like, where do you think your rate needs to be? And the answer was, we'll sell it. And it really was, you need no movement. I think if you're going in, and at the time, maybe rates were high 2s, low 3s, to get out at a 7.25, rates had to be 375. And now you're doing deals 8, 9 debt yields. So that's kind of where the issue is kind of started.
Yeah, and Ezra, I'm curious on more like from the private lens, where your head was at back then, and no judgment, of course.
So it's just interesting to me. We talk about debt yield, and it was kind of like we had a matrix of the types of loans we do, and debt yield was all the way on the right, but nobody knew what that meant, and nobody's, like, the underwriters didn't really care. Them, yeah, of course you're going to hit your 7 debt yield, and it was much more LTARV, loan to after repair value driven. And for us, it kind of flipped. So it almost doesn't even matter today, like, what your L to ARV is. Get me to a 9.5 debt yield at the end of this deal, and I don't care what my loan is based on the ARV. If we're there, we're there. So that to us was like just one of the most significant factors. The other thing for us, just in underwriting, as things changed, has been a lot more focus on sponsor track record. So we've really focused a lot more on just digging in and understanding who our borrower is, and if they've been through a cycle, and what they do when things go a little bit sideways. So my favorite borrower, and I hate to say it this way, is a guy who defaulted on one of his loans. One of my favorite guys at this show, and I saw him earlier today, he defaulted on our loan, and he gave us back the keys. He said, look, here's the best I can do. I'm giving you back the keys. We didn't lose any money on it, and in a cycle like this is the type of guy who I want to work with again, because I know how he behaves when things go sideways. So, like, reputationally, in these type of times, showing how you act when things get difficult, to me, is as important as debt yield and DSCR and L to ARV. So,
I think that's a fair point, and I feel like when you're a relationship lender, people think relationships don't matter. Maybe with savings banks sometimes not so much, but I think especially with a private lender, reputation, it matters, right? How are you going to act when shit hits the fan? So
100%.
Alan, I'm curious. Today, I imagine you were somewhat in line a couple of years ago with where Ezra was. Today, where are you pricing a takeout in terms of leverage? Like, are you looking at a debt yield, and if so, like where do you want to land?
Yeah, so we're looking at it from a DSCR standpoint, and this is something that we didn't do 2-3 years ago, to Ezra's point. You were really looking at your loan to ARV, and if you were at a 65-70 loan to ARV, you felt relatively comfortable that you were going to get taken out of that loan, whether it was through a refinance or a sale. Today, we stress test debt service ratios, depending on the asset class, depending on the geography, anywhere with a terminal refinance between 6 to 7.5%. Also depends on who's the borrower, what's the quality of that borrower, what type of financing are they going to actually be eligible for. There are banks out there today that you can still get 5-handle pricing with, or you can go the private non-QM route and take DSCR loans like from a shop like Sharestates, and you're going to be at a 7 or an 8 handle. So it really depends on the quality of the borrower. What do their banking relationships look like? To the extent that we can get some sort of a takeout letter in advance, it also helps us get a little bit more comfortable just understanding who is their takeout lender, how many deals have they done with them, what does the leverage look on their takeout. But generally, we're looking to stress test and underwrite to at least a 1.2 debt service on the exit, if not a 1.25. And then we can get a little bit more flexible on Resi 1 to 4 family properties because there are loan products out there today that'll go down as low as a 1.0 or even under a 1.0.
Huh, interesting. It's interesting you mentioned the takeout letter. I had another lender ask me, or at least say he's more comfortable lending with a broker because the broker knows what the takeout is, and he's just
Yeah.
And I have not really seen that so much. So, Jared, I'm curious also for you. Like, it sounds like you're more or less based on that DSCR around like a 9 to 10 debt yield in current moment. So like 10 times NOI on your loan proceeds. Where are you at today, Jared? Like, where do you find agencies? Are you stressing loans when you're underwriting today?
So everything for agency is just DSCR. That said, like, because we were discussing it, I know like the bridge capital markets world, everything is debt yield driven, and debt yield is realistically a smarter metric than DSCR because when rates are really low, debt yields. I mean, these deals that we were doing, agency, floating rate, sizing to a fixed rate equivalent of a 3.25 was like a low 5 debt yield going in, and the leverage that the agencies were doing was something that the bridge lenders would never have done, which is just interesting looking back on it. But it is the market, right? And if the agencies are going to back it and allow it, then people like us are going to do the loans. I said today, I was looking at a deal we quoted, and I thought there would actually be more people in the room, but most people in this room who were in the room, everything is like, if you're going to take an agency loan right now, just where step down prepay is gone, it's been like a 5-year yield maintenance. So like a 5-year yield maintenance deal at a competitive spread of like 185 potentially, and that's like the lower end of the market for Freddie. You're somewhere between like, this deal I looked at this morning was like an 8.8 debt yield going in, which seems high in reality, but it just is what the market is.
Are you able to take out the bridge loans on your book, or I guess for you it sounds like you guys were a little less stretching on the leverage, but like are you seeing a lot of those agency deals that were in bridge not figure for a perm now?
I don't think that we have looked at a bridge deal that actually worked, and like a true bridge deal. We've seen deals where there was some situation, harder type money, close quick and come back for a refinance, or they bought it vacant and did some work and wanted to now put the refi on. But anything that was taken out with like a true bridge in the Sun Belt, like those deals just don't work right now.
None of them.
I have not taken out a ladder or any of these deals. That's just the honest truth. We've taken out floating rate deals. There's like agency floaters to put into fixed rate debt, and some of those situations are because the escrows are just really bleeding them dry. So to reset their cap, get the escrow money back, buy a quote unquote more expensive cap with lower escrows because you're escrowing today for a strike rate of 2021 at an in the money cap. So those are the type of deals where floating rate debt that we've taken out, but I have not taken out a traditional bridge deal yet.
Wow. And anecdotally, do you find that those guys they're finding someone, or are they like you hear from them afterwards, like they're giving the keys back?
honestly, I don't think they're not giving the keys back, but they're exercising an expensive option that they don't really want to exercise, that their investors, when they invest into the deal, really did not really entertain actually having to exercise that option. And it kind of is what the market is. I mean, there's deals that we've quoted 10, 15, 20 times over the last, 7 months, but 7, 8 months. But the truth is, their business plan is still formulating. NOI growth is substantial. Like, I'm just thinking of one deal. We did a loan in end of 2020, or in 2021. I'm blanking. NOI is up $1 million, and I'm still $11 to $12 million short on their senior.
Wow.
So to go in and absolutely crush it, but to be so far out because of interest rates is just, it's tough.
Interesting. Yeah, I mean, listen, from my point of view, I've seen it. I would say the marketplace for smaller loans, bank-wise, was like, an 8 debt yield 2 years ago, right? And so perm debt, more or less at 10 times NOI, a 10 debt yield, like you're fine to take that stuff out with a decent amount of rent growth. But if you didn't execute your business plan and you weren't helped by a significant rise in rents, you have to be building to at least 7.5, 8 yield on cost to be taken out. No, like I think it's
like almost impossible.
Yeah.
Based on the deals we're seeing.
If you were buying at a 3.5, it's probably difficult. So let's pivot to where we are now and in terms of what's on your guys' books. I'm curious on the private side. What % of your borrowers are in trouble, and would love to hear also as an anecdote, multifamily versus 1 to 4, and really dig into like then how are you guys dealing with these borrowers, or how are they dealing with you? Like from whatever perspective you want to start. Ezra, you want to?
Oh, sure. Okay, so they're almost two. I feel like it's two different worlds. The 1 to 4 and the multifamily, and I'll just at least look at like SFRs. So the SFRs that we did as either light rehab or bridge. It's all right. I can talk louder than them. The SFRs that we did as either light rehab or bridge, those things have held up well just because prices have held up well, and they're less. It seems like they're less rate sensitive. And I think a lot of that has to do with the 30-year mortgage, how that provides insulation for like, so my house, everyone here hopefully has a house, they have no mortgage, but I have a 30-year mortgage on it, and I have 27 years left at 2.5%, so I'm not a seller for a while. So it seems like that propped up the housing market, so the 1 to 4 light rehab has been pretty strong. But then when you move over to multifamily, things change, right? So the deals that we did that were, we'll say, the most speculative or the highest risk deals, those have been the ones that have performed the best. So our heavy rehabs, and I see some of my heavy rehab people here, in the back also. The heavy rehab stuff that you were penciling to like a 60 to 65 ARV and like an 8.5 to 9 debt yield, rents have gone up enough, and there's been enough room. That stuff has performed really well. Ground up construction performed really well. What hasn't performed so well are the loans that are that 75% bridge that we did at 6.5%. Okay, we just need it for a year. We're changing some tenancy. Everything's going to be great. You're at 75. It covers. And guess what? They thought it was a 4.5 cap or whatever it was, and now reality is not anywhere near that. And I mean, where we've been with that is we've been working with borrowers who have been willing to work with us. So different types of guys have approached us in different ways. For one borrower, that was one of those types of deals, we allowed a refi that we held I'm not sure if it was a mezz or pref equity piece at the end of the day. And so it was a $10 million refi, and he didn't have the money for it, or the proceeds weren't coming out, and it looked like, okay, if you leave $300,000 in, we'll be done with this. Within 6 months, we'll get our money back, and everything will be fine. So to us, that was a great outcome. and we were willing to do that. For other guys, it's kind of like, okay, they need an extension, right? We're getting our rents up, but we need an extension, and we were willing to extend for, I don't want to say a pound of flesh, but for like better security, right? Where you go in and you say, look, I'll give you either a deed in lieu, or I'll agree to pay down the loan by a certain amount. Give me an extension. And we've done things like that. And look, and we've also encouraged our borrowers to sometimes get real. And I've told people, I'm like, lose money. Lose half of your investors' money. Because if you wait, you're going to lose all of your investors' money. Everyone knows that that this multifamily stuff has gone kind of sideways. So if you're able to go back and say, look, I did the best I could. Sorry, guys, you gave me $10 million. Here's $5 million back. We'll live to fight another day. That's what I've encouraged people to do, as opposed to guys who say, look, I can't go back to my investors with a loss. I'm going to go down with the ship and swinging. And as a lender, we'll swing back. But if we have cooperative guys, we'll really try to figure something out. And then, one more thing. And then we'll be more flexible on our own takeouts. So we have, and everyone here does too, balance sheet capacity for term loans. So we'll figure out something that's a little bit like kind of stretching our guides a bit. If it's a loan that we want to take out for a borrower that's been really cooperative the whole way through. So.
Would you parrot that, or I'm curious to hear from your vantage point. Every shop is different, has different pool loans.
Yeah, I think being flexible in today's environment is the most important thing. So the delinquencies that we've seen haven't really been for failure to exit on completed projects, but it have been from borrowers that didn't execute their business plan. So construction stalled out, they weren't able to complete. That's a completely different conversation and story than somebody who's executed on their business plan. They've increased their rents, they've developed whatever they were going to develop, they've leased up the property, and now they're facing a debt service coverage ratio issue on their exit. And so I think what the market's done really well in the last year has been to develop products that help bridge the gap. So there are agency lenders that, the senior, for example, might not get where they need to be, but they're also offering a balance sheet mezz product that goes on top of it, which helps them exit. Or there's pref equity and mezz shops out there today that'll come and sit behind bank financing or agency financing and help them exit. But I think the flexibility and the communication is the biggest key, because when you have a borrower that turns off their phone, doesn't respond, doesn't communicate, you can't help them. And you're kind of in this inherent position where you're afraid of your lender, when in reality, you and your lender want the same thing, which is for the loan to perform and to get out from under it, right? So those borrowers that communicate and are transparent and come, full open kimono and say, here's my problem, this is why I'm stuck, we can oftentimes help them find a solution. It might be bringing in a mezz partner, it might be bringing in somebody who's a pref equity shop, it might be bringing in another street borrower that is active in the market and isn't afraid to partner with them. It could be what Ezra mentioned before, which is we'll allow, call it a short refinance, but we'll take some sort of a mezz position on our own balance sheet or on our investor's balance sheet, which will let us live to fight another day 6 months from now, a year from now, as the market continues to improve. And look, those are your political solutions, right? But then there's also the non-political solutions that we probably shouldn't be talking about as lenders, which is the borrowers have an opportunity based on, and this is very facts and circumstances oriented, right? But we're in a market today where, depending on the size, scale, and scope of the borrower, as well as the lender and how they're set up, there are different solutions, and that could be just a straight up short refinance or a short sale. There's a funny saying, if you owe the bank $500,000, you have a problem. But if you owe the bank $50 million, the bank has a problem. They're forced to work with you, right? They've got to find a solution. So being able to go in and have those conversations with your lender and find those creative solutions are important. Knowing who your lender is, and I think this is the heart of the panel today, right? Which is, what do you do? How do you get out of your bridge loan? So don't quote me on this, but knowing who your lender is, how they're set up, are they purely balance sheet? Do they have warehouse lines? What happens when they get a substantial delinquency book past 90 days? Do they get a call on their warehouse line? Does that put pressure on them to settle with you? Does that bring them to the table to work something out with you? Can you offer additional collateral? If you're a larger borrower that has, let's say, an online portfolio at relatively decent, stabilized rates of 3-4 handle pricing, do Do you have an opportunity to bring additional collateral to the table and create some sort of structured workout? The point is communication is going to control what ends up happening. Not communicating and or not being transparent is the worst thing you can do.
Interesting. I'm curious for both of you as well. Like, do you find that people are proactive? Like your borrowers are proactive about reaching out to you, knowing like, I have a problem most likely here.
Some of them are, and some of them duck for cover, and it requires a little bit of finesse. And it's funny, so we're a national lender. We've got about 60 people on staff, CEO of the company. I very much believe in doing whatever needs to be done to help move something forward. So if that means that I personally have to get on the phone with a broker or a borrower to find a solution, not that the other people in our company aren't capable to do it, but sometimes there's just a different impact when you have the owner of a company reaching out to you. It gets their attention. I'm happy to do that. So sometimes it just requires a little bit of finesse, walking a borrower or a broker through the situation and saying, hey, the worst thing you could do is not communicate. Here are some potential solutions that are on the table, but you got to work with us. You got to talk with us so we can help you get to the finish line.
Ezra shaking his head.
I mean, just to answer your question, nobody calls up and says, "Oh, I'm having some stress." It's kind of like they seemingly let it. I think a lot of the borrowers are optimists, so they think they're going to solve things. But we monitor closely renovation progress, and like as you're nearing the end of the term, we're making sure like we're on top of that, and I think we're always making the first call.
Like,
right?
have you guys implemented some sort of protocol on your asset management side, basically like, 6 months out from any loan, like regardless of how it's performing, you're like, let's have a call with the borrower or?
We generally don't unless there's some cause for concern. So you start to see payments start to roll delinquent. You see an we also self-service all of our loans, majority of our loans. You see an auto pay bounce. There's red flags. You see a project that hasn't taken a draw in several months, construction draw in several months. So we have certain flags that'll cause us to reach out proactively. But otherwise, if the borrower is paying, I think in today's market, we all have enough other problems that we're not looking for more, if that makes sense.
Are you guys going back and looking at your underwriting and questioning, because I've seen that now where lenders are reaching out to my sponsor saying, you budgeted $900 a unit for payroll. It's at $1,200. And, during the time, it was like, I remember working with the originator at X lender shop to find comps at the lower payroll unit, right? And to sell it through because it was 2021 and everyone wanted to do deals. And now, like, asset management is just, like, blasting these sponsors. We need to see this report, this report, this report. Almost impairing a sponsor who's, like, doing the best he can to, they're drowning him with reports. Maybe that's because they're trying to sell it potentially and they're trying to gather as much information. But I'm just curious, like, are you guys going back and saying, like, why did we do this and why did the sponsor tell this? Like, because, like, I've seen it now where they're questioning
Jared,
the
are you married?
sponsors.
Are you married, Jared?
I am married.
Okay, that doesn't work in the house, and it's not going to work with your borrower either.
It's a common thing, though.
I know. So, like, if I go back and I say, hey, a year and a half ago, you gave me this, and I don't know, that was like they gave me their numbers. We did our own underwriting. Every deal we do our own underwrite. Their numbers are kind of like for reference only. Like it's
for sure.
Yeah,
it's all bullshit.
We have our own numbers, and then we have like the appraisal numbers. So we're doing our own underwrite. So we better be good at it.
Yeah.
But I think where the issues come in more are we're gonna just take a look and say, hey, where are debt yields coming out now, and making sure that those things are healthy. Other thing is, but what does change, and what we're going to be proactive about, is the budgets have changed a lot. So the budgets moved like substantively, where the inflation that came like just ripped through a lot of what we're doing. We have borrowers that are hundreds of thousands of dollars, like I don't want to say underwater, but short.
Yeah.
And they weren't planning on coming out for an extra $300,000 on a $1.5 million project or $1.5 million renovation.
It could also just be like insurance, like one line item.
So luckily rents have grown, but we'll figure out stuff with them. Like, okay, we'll either refi or place a second behind ourselves. Those people will do that kind of stuff.
So guys, if you're a borrower,
Sorry about the marriage thing. I hope
Hey, it's all good. It's all good.
I can just imagine my like checking with my wife, like, why did you do this?
Ezra loves the marriage.
Yeah,
jokes.
24 years.
So I guess if you're a borrower in here, right, and you know either maybe you're working through one right now, or you know you're going to have an expiring loan, and you're going to have a conversation. Maybe it's with one of you two. You know, what do you want to see? Like, what's a good faith first step on a call? Like, you know, what would you appreciate as a lender? And really, like, I think you kind of alluded to it before, but like people don't necessarily think of a lender as a partner, but like a lender is an investor in a deal who has a certain return profile and a certain risk profile, right? You're a risk-averse investor. You lack upside in rate and return, but you have controlled downside in a lot of cases. So, you know, as a partner, like, how do you want to be approached, and like, what do you find is the difference between when someone's reaching out to you in a hostile versus more, I guess, agreeable and I guess like an agreeable manner, let's call it.
So for us, I think it always goes a long way when a borrower is willing to offer some additional protection, right? So, and again, it depends on what the issue is. Do they need additional money to complete construction? Do they just simply need more time? Are they looking for some sort of structured refinance? It really depends on the topic. But I think offering additional protection, whether that comes in the form of additional collateral or a deed in lieu to be held in escrow, confession of judgment to be held in escrow in exchange for additional time, is always super helpful. Coming with a plan, and it's okay if you don't have a plan, right? Sometimes the call is simply, hey, we're stuck, like, what are our options? But coming with a plan of, I spread myself too thin, I'm doing, you know, a dozen projects right now, here's my timeline for completing project A, B, and C. I'm expecting cash flow to come from these projects. It enables, the more information they give us, the more readily available we're going to be in terms of finding a solution for them. I think coming out and offering, and there's probably going to be some differing opinions on this, but I think offering strictly a deed in lieu and just walking away is not a good first step. Because at the end of the day, when we're dealing with a borrower is always going to be in the best position to see a project to completion than a lender. And again, it also depends on the market and where you are. So I'm less inclined to take a deed in lieu in the middle of whatever, the country somewhere where I don't have a footprint. But if it's a borrower that I'm dealing with in New York and New Jersey and we have a serious operation set up here, I'm more inclined to do that. So it really, again, it depends. But I think that's the worst thing you could do. Don't offer that right off the bat. Offer a deed in lieu to be held in escrow in conjunction with some other plan to show that you're proactively trying to find a solution and you're not just trying to give up the keys to walk away. Yeah.
So can I plug you for a minute?
Yeah, sure.
Okay.
Sure. Please,
So-
please.
So here's everything you just said, 100%. Other thing is kind of an all hands on deck. Like, okay, look, this thing's behind. I need an extension, but I have Andy working on the refi, and speak to him. Andy, tell them everything that's going on, and I now all of a sudden have visibility into, okay, I'm working on a refi for it. Then maybe it's going to work, maybe it won't. Andy has term sheets that he's going to tell me about and what the lenders are really going to do for him. So that visibility and cooperation gets me puts me at ease, and especially if it's someone like Andy, who happens to be really good at what he does, and I also trust, right? So I don't want to minimize the trust factor. So Andy's never going to lie to me, right? Because it's just not worth it for him. Forget if he's a good guy or not. It's just not worth it, because I know once he knows once we lie, that's it. It's over. We don't trust each other anymore. But a borrower who's like, okay, I'm trying to avoid foreclosure, he has motivation that's different than Andy's. So I'd say if you can cooperative with trusted, I don't want to call them intermediaries, but trusted additional players, it makes a big difference. Was that a good plug?
Yeah, I appreciate it. I appreciate it. Very much appreciate that. So, you know, I guess I definitely want to leave a good amount of time for audience questions, because I think people have pressing questions on their own potentially. But I did want to talk about, I guess, just general rate predictions and how you, kind of going back to like how you think about underwriting in today's world. You know, the Fed recently raised rates again. It seems indicative that they'll raise another quarter point potentially, but realistically, I don't think it's a question now of like, okay, like how much are rates going up. It's really like, or will rates go down? It's really like, when will rates go down? And clearly the marketplace also thinks that in 5 to 10 years, the rates will significantly drop with the inverted yield curve. But from your guys' perspective, do you look at this as a 6-month, another year of treading water, or do you think we're in this rate environment here, perm debt in high 6s, 7s for $1 to $5 million deals in a lot of cases, even in New York? Like, is that the environment you think about? Do you think about even worse? Do you think maybe a little bit better? Like, what's going through all your minds?
So if I had the crystal ball, I wouldn't be sitting here. But if I'm going to guess,
I trade interest rate derivatives, so yeah.
If I'm going to guess or speculate, I should say, I think rates are probably going to stay relatively. Let me caveat that. I think rates are going to stay relatively flat for the next year, and then we're going to progressively, for the year following that, see rates come down. How quickly they come down, I don't know, but I don't see us moving in the next year. I think we're going to be plus or minus 25 basis points where we are today. As far as pricing and how that translates to agency lenders, banks, it's not just where the Fed rate is, but it's what are treasuries pricing in, and then where are swaps, and those are also a function of liquidity in the market, which really depends on fear in the market. So I think once that fear subsides, you're going to see liquidity come back in, you're going to see spreads tighten, and with that, you'll see that translate to lower rates, perhaps quicker than even the Fed actually reducing rates. But that's a guess.
For sure. And Jared, I want to hear from you in a second. The one thing I would say, though, with thinking about treasuries being where they are, and I think people sometimes struggle to understand why credit spreads widen, but ultimately banks are borrowing at overnight rates and their deposits are at overnight rates. So if you're paying your depositors high 4s, low 5s, like, and most banks are suffering from some level of liquidity crisis, let's say, like, banks need a certain amount of spread just to make money. So, like, they're not going to lend in the high 5s, most of them, right? They're not going to lend in the low 6s, especially the smaller guys is what I find. That's the challenging part about an inverted yield curve, I think. Like, people are like, oh, like, treasuries are still in force. Like, let's go, right? Like, why are rates still going up? It's like cost of funds is up. So Jared, curious on the agency side, like how you're seeing it.
Yeah, obviously treasuries will dictate kind of what everything we see, and I think the sentiment that kind of have maybe seen the higher end of the treasury curve, and hopefully it's not going back to that like 440, 450 area where the 5, 7, 10 years trended and back down. But I think like the norm of like, will we get back to the low rates that we've seen? The answer to me is no, and our traders kind of inflow us with data constantly. Hopefully the 10-year can trickle back to 3.5% by the end of the year in a hopeful manner. But for like my world, there's just going to be glimpse of pricing. I don't want to call it specials, but the agencies need to put out X amount of dollars per year demanded by the regulators. So, Freddie was way behind this year. So you'll see Freddie spreads today, potentially 30 to 40 basis points potentially inside of where Fannie is on a more like the typical 125 deal on a Fannie higher leverage or lower leverage, higher DSCR. Sometimes, Fannie can get more competitive, but Fannie has increased 3 or 4 times in the last month or so, and Freddie Mac has decreased 2 or 3 times in the conventional space. So you've seen sub $7.5 million increase because their focus was potentially more on middle market, because the middle market, 5 to 50 unit space across the country is where most of the affordability that they needed to hit stood. They got enough of that under their belt. Now the goal is dollars. So, larger loan sizes, drop spreads. And I mean, to me, just talking to sponsors on a competitive deal, where I looked something where Freddie's like, we like this transaction and we could probably get down to like a 165 spread. That's a 565 to 575 rate, and you look at where the treasuries are, and you're like, that's a great interest rate for this market. So it's really going to come and go, and it's not all going to be dependent on the treasuries. I think it's going to be dependent on what the real estate market itself does, and if the agencies can't do enough volume, you'll see interest rates in multifamily potentially trickle even though treasuries are increasing, which hopefully will strum up business for multifamily trades to happen. So that's some hope.
Fair discrepancy between capital markets and bank work. All right,
And that's why you haven't seen banks compete, right?
yeah,
Like,
yeah, it's true. I'm curious though, one thing, are you finding that you're able to get to max leverage on those deals? Like, I mean,
depends
cap
who the
rates are
deals
still pretty
is.
low, no?
Yeah, I mean, like, the truth is, the rougher the property, like, the better the leverage is for agency. Because usually, rougher the property, higher the cap rate. Also, the rougher the property, the lower my rents, which increases my mission. And ultimately, the rougher the property gets you, the better interest rate.
Believe they call that adverse selection. Yeah. So
Which
Ezra,
is just ironic. But
So I'll give a shorter answer. I'd bet that within 6 months, the 5-year, we see significant movement, like the rates are going down. I think we're going to see the spreads going down as well, kind of like as the market normalizes and things get back to like people are less freaked out. So I think about 6 months you'll have significant movement downward in mortgage rates. I think that the overnight rates, you have a while before that's going to happen. I'd say 14 to 16 months.
yeah. I think it's like Q3 of next year, the forward curve starts to dip or something.
I'll just say my chief investment officer or my chief credit officer believes that things will start to move down before the election and it'll be political. I don't know that I agree with that, but just throwing the other voice out there.
okay, got it. He looked in his crystal ball, and that's his thought. I got it.
And he's not on this stage, so he has the crystal ball. He's not here. Yeah.
Respect. Okay, well, thank you, gentlemen. I do want to open it up for questions. I imagine we have a good amount here. Handsome gentleman in the front. No? No one?
Are we giving extensions? So, free extensions. So, that's a question I think that was meant like a little bit in jest, but so an extension is like just a business deal. So there's no such thing as a free anything, right? But if we have a loan and you come in and say, okay, we have a $1 million loan and I'm going to pay it down by $300,000 but I really need a free 2-month extension. Yeah, I'm probably going to do that. If you just come to me and say, hey, can I get a free extension? No, I can't do that. And the one thing we didn't mention, which Alan mentioned, was like, or he said that you can be a problem for your lender, but this is kind of like a game that everyone knows what we're playing. So if I give you a free extension and you tell all your friends about it, I'm not getting paid on any extensions anymore. And if you go into default and think you're going to strong arm me, I need to be stronger. So you can tell your friends, oh my God, that didn't work. So a lot of it also is kind of like the reputation that we're going to put out into the market of being cooperative and being good partners, but also not being pushovers.
I imagine a lot of your extension options are pre-negotiated. Do they reset on the rate, or like do you guys have like 6% rate loans out there?
All of our bridge stuff is pretty much at lender discretion, and guys who have 7-8% rates, they're not happy with the new rates coming up now. Yeah,
We're also resetting to market. It's not something we've done. I'd say probably started that about 6-7 months ago. Prior to that, it was just an extension fee. You kept your same rate for some period of time and you'd move forward. But more recently, we're having to reset rates.
Got it. So these guys are going from like a 6, 7, 8 to a 12.
We were never lending at 6-7 on bridge. They're going more from like an 8-9 to an 11-12.
Okay.
So I haven't seen it from banks, but I've seen it from private lenders. So I had so you got to be careful with your lender. They were at a really low LTV, and this lender who's now, they have no money. They planned on selling this loan. It was a bridge loan at like 6.5%. They're not doing any more business. And they're putting the borrower in default for not having a draw done within the first 10 days of the loan.
So they're going back.
They're going back and they said, you didn't do a draw within the first 10 days of the loan. We just found something in the loan docs that says you have to do a draw. You're in default, get out. And so, I mean, yeah.
I've seen that happen. Yeah, I saw a lot of that happening earlier this year. Not from lenders, but from the secondary market, that a lot of these loans ultimately get sold into. So the loan buyers coming back and saying, for whatever reason, they weren't able to get it into a securitization on time, and now they're sitting on a sub-market coupon that should be trading at 80 cents on the dollar, because these things get dinged very quickly. And we got caught up actually back in April of 2022. We were a victim of this at Sharestates, where we had closed loans that still had 3 handles on them, 4 handles on them, 3 handles. And within a matter of 60 days while we were waiting to sell, this is before we started locking loans on the secondary market, so on and so forth, loans that should have been trading at a 102, 103 premium were all of a sudden trading at 97, 96, 93, 92, and it just kept trickling down very quickly. And so the same thing happened on the secondary market, where we've seen some of the buyers that weren't able to get those out into securitizations and off their balance sheet look for technical defaults to force those borrowers into a refinance. But again, this is earlier in the year. I'm not seeing it so much right now.
That's big guys or like the smaller shops?
I don't want to throw any names out there.
Oh, yeah.
Big and small.
But both.
Yeah.
Both.
Would you say that a lot of the competition in your spaces is kind of thinning out because they're not able to handle this environment? Maybe they're not equipped for workouts. They don't have good relationships in the wholesale, like enough relationships in the wholesale or secondary note space.
I think clearly it's thinning out, right? So like we have, I think, fewer real competitors. A lot of the competitors that we have are like Alan's a competitor, but then like we have some other guy who's just a competitor who's like white labeling Alan's product.
Yeah.
So there's more guys out there who are claiming to be lenders, but there are like I see fewer and fewer real competitors out there.
If you're a borrower, how do you know if you're dealing with a real lender versus someone who's white labeling?
There could be some cue in the term sheet, depending on what the term sheet looks like, because a lot of correspondent relationships force you to use a specific format.
Yeah.
So you could look for that.
I'd say you know you meet your lenders. So look, I mean, people will, if they're open with you, and first of all, look at your loan docs, right? What's the LLC on the loan docs? Who are you working with? And that's kind of like it's telling, and you can track your loans. I don't know if it makes that big of a difference, but you kind of want to make sure that at the end of the day you're working with like a good lender, and the white label guys have like they serve a purpose. So I'm not going to tell you how to.
We're also New York. I mean, you're a click away from Acris. You can figure out who's selling their paper and where it's going relatively quickly. So if you really wanted to do the diligence and see where that loan's trading after.
Yeah, and I guess as a selling point for you guys, you know, what do you, you know, and I would also say, you know, like as an agency platform that's retaining all servicing, right? Like, what do you see as really the competitive advantage, right, in terms of doing asset management as opposed to not, like, right, as opposed to you know, just all right, see you, like, originate, check, done.
I think almost everyone in the agency space is servicing their own loans. I know some definitely outsource out some of the areas of servicing. But, I mean, one thing about that, to be honest, the fact that we do service our own loans, it sometimes causes stress on the relationship because, for instance, you know, you're in a floater and the escrows are killing you and the client's calling you, you know, to complain about it. Once it's securitized, like, there's really nothing we could do. You know, at the end of the day, we really are just servicing it, and we could help advise and guide, but we can't go back and change the loan docs, and nor would the B-piece buyer agree to that. You know, if you did a loan at a 3.5% fixed rate equivalent, and at that point in time, to cover, you had to buy a strike at 2.5%, and that 2.5% strike is costing you, $30,000 a month when a new strike would cost you $5,000 a month. We just can't change the strike, right? And we get those calls all the time, like, why can't you help us? And everyone's, X agents, CBRE did this, like, they didn't do that for you. And if they did, it was a different situation. Like, there's nothing that we could do. I mean, I think some shops do it better at managing the servicing relationship, but at the end of the day, like, once it's securitized by the documents that it was done by.
Do you find it challenging because you have some products you're selling off and some you're holding on balance sheet, and borrowers, I imagine, are commingling, for lack of a better term, right? Like, they're doing both with you. Is it a struggle sometimes to explain, like, hey, I have less control here versus here? Like,
I mean, it's never a fun conversation to have. So we do sell 100% of our paper, and for the most part, I'd say 95% of what we sell, we end up self-servicing on bridge, not on term. And so yes, we get those phone calls all the time, and we have to say, well, we've sold the paper. There's a different investor involved now. You're still interfacing with us, but it's not our decision. We can advocate for you, but it's also a fine line in terms of how much we can advocate before you potentially upset the investor that you're also selling your paper to, right? So it's a bit of a back and forth. But I find that if you're transparent with your clients as to the fact that you've sold it, and even as far as to say who you've sold it to, and you explain that it's not really your decision, but that you're trying to help the cause, they'll work with you.
So we keep, at this point, most of our bridge on balance sheet, like half of our term stuff on balance sheet, and then we'll only sell generally to important relationships. So, like, if I have a note buyer for a specific loan and I sell them that loan, that's a problem, right? If you're my borrower, you want to make sure, if I'm selling to someone, that I have a multi-$100-million relationship with that note buyer. So that if you have an issue, I go in and it's my relationship as opposed to a loan that I'm trying to ask for a favor for. So that's been for us like a way to kind of maintain that same level of service throughout. We'll also generally, for draws and things like that, we'll retain the ability to just fund draws. So if a note buyer disagrees that this amount of work wasn't done, we can say, look, we're funding it, and you collect the interest, and it'll be our risk. Those are things that we've done. But reality is that no matter how big the relationship is, if the borrower is defaulting or like playing games, like, we're not sticking our neck out, and that note buyer probably isn't going to care at that point anyway. If they're going to mess around, that's it. Mess around, and like at your own peril. And we had a borrower who was really upset with us, hadn't paid in like 7-8 months, and we cut a deal with a note buyer. Okay, we'll get you half the default interest. Just get it done by this date. Everything cut in half, and he's like, nah, I think I could do better. And we're like, no, dude, we're telling you, this is the best deal you're going to get. We called in a favor for you, and then didn't do it. And the note buyer's like, you know what? F this guy. We're charging full default interest on the whole thing. Done. You want to go through the default process? You want us to foreclose? We're doing it. There is no more talking about this. And that borrower got really upset with us. So I said, look, we did the best we could. We did what we thought was appropriate. You had a hard time, finally we worked it out, and then you played games. So we can blame it on the note buyer at some point, but we'll just say, look, we agree. So.
Yeah, and just listening to you, it highlights to me that it's important, I think, from a borrower standpoint, to remember, it's not always your decision, right? It's not always your capital that you're lending, and so you have partners, and
it's never all my capital. It's never all my personal money. I promise you that. I promise you that.
Okay, Ezra. Okay. Are there any other questions? No? Comments? All right. Gentlemen, thank you very much.
Thank
It was
you.
a pleasure.